Hey family, how are you? It's another week. So we started out talking about debt, faced some uncomfortable truths around that. And then we moved on to behaviors that initiate and put us in these cycles of debt. And then we had to take a look in the mirror for that and make some adjustments. We talked about building systems. And for some of you who've been tuned in and doing the work, you've maybe restructured your entire budget. Then last week we had a legacy talk and you started thinking beyond yourself, or I tried to push you to think beyond yourself. This is dealing more in the rewards aspect of it. So once you build the foundation and that is solid, and then you get ready then to build up beyond the foundation. And so, in the vein of being in one of my investments, we're going to talk about tonight multiplication. Tonight's conversation will be about multiplication. And I want to be clear about something before we go any further. This is not a conversation about being rich, because I get that a lot, right? People think because you own real estate or because you're an investor, you're rich. That is not exactly true. Some investors in real estate and overall general investors, paper assets, and other types of assets are rich and have become rich or wealthy, however you want to define that from their investment. But this is not a conversation about that. This is a conversation about being responsible what God has already given you in order to multiply it. And then hopefully you can have investments like the one I'm sitting in today, which is a bit of a lifestyle investment. Yes, it does produce income, but I can travel out here out west. I can stay in the property. I can write off expenses for my travel and the maintenance and all the furnishings that I've bought for the unit. All those things are permissible from a tax perspective. But let's get back to this conversation of multiplication. So for this, I want to focus on Ecclesiastes chapter 11, verse 2. I'll read it from the New International Version. Invest in 7 ventures. Yes, in 8. You do not know what disaster may come upon the land. Now, somebody that is reading that is probably saying that sounds like that came fresh off of CNBC or MSNBC or Fox News, as we live in the present day time where there's war activity in multiple parts of the world. So, unfortunately, it wasn't written by a modern day pundit. It was written thousands of years ago. So we can see that conflict, downturns in economy, they've had many different names. They were called famines once upon a time when they weren't in a fiat currency environment. But we call them downturns, we call them depressions, we call them recessions. We've always had a name for it when what happens naturally in nature when the flow of resources begins to dwindle. So I think it's timely from a socioeconomic and political standpoint, and it's timely for me, having spent the last 2 weeks investing in this venture, for us to have a conversation. So the text is really telling us about diversification. And I know that in the investing world is a bit of a misnomer, because when people talk about diversification, typically, as they talk about investments, they're talking about diversifying paper assets, stock. They're talking about buying stock in multiple companies. It's all the same type of asset, but the resources are divvied up into different companies, which is a strategy where if one company takes a hit, the other companies may be seeing a profit. So the portfolio is still increasing. But what typically happens with paper assets is they all get impacted, particularly if you're invested in heavily invested in one particular sector like tech, which has been very common these days with AI and chips and all the different things. Your entire portfolio can be affected simultaneously. All we're having a conversation about is once we get a foundation of managing our budgets and now we have money to invest, do not put your money in one place, but put it in motion. The Bible isn't against wealth, it's against hoarding wealth without a purpose or for the sole purpose of gratifying self. That's where wealth becomes a negative spiritual bond or hindrance or all of those things when you are the center of the wealth production. The Bible isn't against wealth. I'm sorry, I jumped ahead a little bit there in my slides. The Bible isn't against wealth. Like I said, it's against that hoarding, that personal gain, the feeling that you never have enough. That's where it becomes corrupted, and then is not necessarily positive. So there's a difference between storing money and deploying it. Stored money is protected. Deployed money is multiplied, typically if you deploy it in the right place. So I want you to write that down. There's a difference between stored money and deployed money. So here's a quick story I want to sort of go into for the sake of just bringing this all home. Picture someone, she works hard, she has two kids, tries to do everything right. She's a Christian, she tithes, she saves a little every month, and she tries not to overspend. But now at 52, she looks at her account and realizes that after 30 years of work, her savings they basically are at the same stage and numerically almost identical to what it was 5 years ago. Not because she spent it, because inflation is quietly eating away at it and our costs creep up. Money sitting still in a savings account is actually losing its value. I want you to hear that. You've probably heard people like Robert Kiyosaki talk online that savers are losers. That's what they're talking about. They're not just calling you personally a loser. The value of the saved money is losing year over year as inflation increases. That's why I've never been a fan or a proponent of the nest egg theory, because I always say, in order for the nest egg theory, which every bank and wealth management and investment institution preaches, in order for that to work, you need to know two numbers: the number of years you're going to live on Earth and the rate of inflation for every year that you're alive on Earth. And then you can calculate the amount of money you will need until you exit. If you don't have those two numbers, then you're gambling. Nothing wrong with that. You could gamble and win and have more money and have something left over, like we talked about last week, for your children's children. But most people don't do that. And so they're taught, like the lady in this story, that savings is the way to do it, but savings alone is not a strategy. And so we're going to try to close the gap on that tonight. So there's a core problem here we have to look at. And here it is. Most people are the only one working in their financial lives. It's you. It's all dependent on you. You trade your time for income. If you stop working, your income stops. And no matter how disciplined you are, there is a ceiling on the amount of money you can make. There are only 24 hours in a day. Only that much energy is God giving you to work. You can't work more hours than anyone else on the planet, right? So it's not about how hard you work. The question is, how do I hire my money to work alongside me? I think Warren Buffett once says it. He said, if you do not find a way to make money while you sleep, you will work until you die. So you have to find a way for those resources that you're trading your time for to actually put them to work in other vehicles. So here is the multiplication framework that we're going to discuss tonight. It's just some short steps. I've been trying to keep these light for you so they're easy to sort of record, jot down the information, and try to find immediate application. So number one is your understanding. You have to understand investment vehicles. They're out there. They're well documented. No one's hiding them, but you have to do your due diligence and you have to make the time. People talk about their 5 to 9 after their 9 to 5. Well, the first part of that should be education. You should be trying to understand, where do people multiply their money? Most people don't invest because nobody explained the options to them in plain language. They just don't understand it. And then they haven't taken the second step to try to research it and understand it for themselves. So let's try to fix a little bit of that tonight. So we're going to start out with the four most common, most accessible, low hanging fruit, if you will, starting points. If you have a job and you're working for a relatively large organization, you probably have a 401k with some sort of employer matching funds. So you don't want to leave the money on the table. You want to contribute something, and then your employer is contributing either equal. Sometimes it's just a flat rate they're contributing. When I worked in healthcare, that there was just sort of a flat amount they would put into our retirement accounts for us, whether we contributed or not. But don't leave money on the table if it is a matching program. So some companies will match a significant portion, and then what you're doing doing is just putting the money in there and allowing it to grow and mature and not dwindle away, if you will. So it's better than just leaving it in a savings account. The second vehicle we want to talk about, you've probably heard a lot about this: commercials, Roth IRAs, IRAs. So if you're under the income limit, Roth IRA lets your money grow and grow tax free. So you can start one a little as $50 a month, and it compounds over time. So it's, do your due diligence and find out how you do it. A lot of times, like I said, it's tax free, and then you can use it just like a 401k. There are some age requirements before you can begin to draw from your Roth IRA. So just do your due diligence with the bank and find out what are the stipulations and the benefits of the product. There's index funds and ETFs. So you've probably heard about these before. I myself am invested in index funds. So it's a fund, a pool of money that's invested into multiple of, some are tied to different indexes, but for instance, the Fortune 500, your money is basically broken up and invested into multiple companies on the Fortune 500 list. Sometimes they're tied to other indexes, but essentially the money's not all in one stock. The money is in a fund, and the fund continues to refresh the list of companies that they're invested in. So if the company falls off the Fortune 500, they'll retract that investment and reinvest it into another Fortune 500 company. So that is in line with the scripture. You're not invested in one particular stock you might have heard of. You're invested in multiple stocks. And then as those stocks move, your money moves and compounds. And then number four, my favorite, it's also easily accessible. That's real estate. This is the one that changed everything for me. It changes everything for a lot of people. It allows you to build communities. It's a real tangible asset. You can see, you can live in it, you can rent it out. Cash flow is a common term. Once you're investing in real estate, there's two type of real estate investors. There's people who invest for cash flow. That means the money that they're making on top of the mortgage and the expenses in the form of rents that benefit whatever's left over is going into their pocket. It's tax-free income. Then there's investing for appreciation. That's investing in the California market. That is buying expensive properties that more than likely will continue to appreciate, because this market has a history of sometimes dipping, but then having exponential growth cycles of upwards of 30%. So these are the four most accessible types of vehicles that most people are invested in. I'm invested in all of these types of vehicles. And then if I could add a bonus to it, I would add number five, precious metals is one I like a lot. It's more of a store of money. It doesn't have attached a monthly or annual return, but instead of keeping your money in the bank, that's why I left it off the list and I'm giving it to you as bonus number five: investing in silver or gold tangibly. It's a way to store your money, and then you're locking in the value of that money. And then in the future, when the gold or silver is worth more, you haven't eroded your cash dollars due to inflation. So I don't want you to attempt to do all four tonight. But what I want you to do is begin to understand these types of vehicles, understand how you exit, how you acquire them, and what is available to you. So the second step in this, after you've educated yourself, start with what you have. Quite simple. Just do that. Pick a date. Today is always the best day. Yesterday was better than today, but today is the next best option to begin your investment life. And this is where most people get stuck. They say, I'll invest when I get more money. I'm going to wait for another market correction. We're in a market correction right now. So now is the time to buy. But here's the reality: people who wait until they have enough, they never do it. So you're in a market correction right now. Stocks are on sale from where they were in previous years. Home values have softened. So, home prices, despite where you are in America for the most part, now is the time to buy. Interest rates have softened. So, in the middle of this economic softening we're seeing, now is the time to begin thinking about how you can multiply any cash dollars that you have in savings and begin to start your investment career. So, like I said, most people who say they're going to wait till they get the money, they never do it. Let me just give you a real number, a real starting point that you can jump into any of the vehicles except real estate, of course. So, if you were to invest $200 a month, starting at the age of 30, and it grows at an average of 8% annually, by 65, you have over $400,000. That number would probably be exponentially bigger, but notice I said by the age of 30. If you actually were to go in and change those numbers and start at 20 and invest the same $200 a month for 10 or 20 years and then stop, you would probably have even more money than the 400,000 that I'm saying if you started at 30. So the earlier you invest and the longer you invest, the higher the dollars are. I'm going to release a lesson probably soon talking about comparing your investment in a car now that they're pushing these longer term loans, and show you how the investment in an average car today would be about $1.3 million over a 30-year term if you made that same investment that you're making in your car note into one of these types of assets. So just think about it. Instead of buying that cool car, you could have $1.5 million when you need it most, when you're not able to work. This is not windfall type stuff. This is incremental. This is not an inheritance. This is just staying consistent over time, picking a dollar amount, committing to it. Some people call it dollar cost averaging. It's when you just come up with an amount and you just continually invest that amount, reoccurring week after week, month after month. So again, the question isn't how much you have. The question is, what can I commit to right now? And how will I protect that commitment and build a consistency? Even if you start with just $50 a month, start somewhere. And the third piece to this, any investment you make, you got to get a security system. You got to begin to protect it. So you got to protect the momentum, and you got to make sure the investment is in a protected asset. So, rule number one of investing is not the profit, it's return of capital. Most people get that twisted. We think about, oh, I'm going to invest in something and this is how much I'm going to make off of it. No, rule number one of investing is get your money back. And then you look at whatever profit you can make. So that's how you define your risk tolerance as you're investing. Again, this is the mistake a lot of people make when it comes to their momentum. They make a one time investment and then they're like, okay, I bought this one stock back in the day when there was an IPO and it first released. I know it's going to be worth a ton of money when I need it. No, that's that same windfall mentality, just doing something one time and setting it aside and think that it's going to just grow into something that you've imagined. Again, you need to develop a system where you are positing those increments or investing those increments consistently over time. That way, when you're in a dip cycle like this, you're already have the habit, and then you can begin to gain momentum as you go through the various cycles of the market. And then you're not resetting and restarting your progress every time. So multiplication, it requires patience, and it requires you protecting what it is you're doing. And you don't want to rush it. You don't want to look for these things that people are telling you. I just bought this and I held it for 6 months and then I sold it and I make a bunch of money. That's not investing. You're not an investor. In order to be an investor, you have to hold assets. So I hear a lot about this in the real estate world. People talk about their flippers and a real estate investor. If you're a flipper, you're not a real estate investor. You're buying and selling real estate. You're not holding any of it. Thus, you're not an investor. In order to be an investor, you have to have the asset within your portfolio at any given time. So we talked about this: automate it, set it up, reoccurring. There's a lot of different apps, a lot of different ways you can do dollar cost averaging. And then the big part of it is not to touch it, delayed gratification. So you don't want to pull from your investments every time you have an emergency or every time there's something you want. You're going to lose the momentum. So in that earlier story that I told, if that person was to pull out $1,000 when they were 35, then they're not going to get to that 400 grand that we talked about. So you want to, as I've taught before, you want to build a separate opportunity fund that's 3 to 6 months of your expenses so that can maintain your emergencies. And then when you get up to the 6 months, then you deploy that, and then it brings in capital that you can rebuild your opportunity fund. But you always want to have your opportunity fund running concurrently with whatever investment funds you have going. Just to review, let me go ahead and land this plane. Multiplication is not complicated. It's not only for wealthy people. It is not gambling, and it's a principle. It's one the Bible introduced a long, long time ago, before Wall Street and before Bitcoin existed. The goal of stewardship was never just to survive. If you want to find the scriptural, there's a story about the talents and there's a story about the miners. Those are stories about investments and why multiplication is important. So the goal is to be a person who manages these resources well and grows them wisely, and ultimately has more to give to the people around them, to their community, to the initiatives that align with their purpose, and like we talked about last week, to their children's children. So you can't pour from an empty cup. It's impossible. So let's fill our cups and let's multiply them. So for this week assignment, I want you to pick one of these and I want you to get it done by Sunday. So you got a couple days to get this done for my loyalists out there. So I want you to log on to whatever HR portal your company uses. If you're a W-2 employee, I want you to find out exactly the percentage that your company matches in your 401k. If you have a 401k or a 403b or a TSP, a tax sheltered plan. I want you to find out how much they contribute. I want you to try as much as you can within your budget to carve out some dollars to get invested into that account so that you can get that money doubled with their matching funds. Two, I want you to do a Google search about how to open a Roth IRA, which banks you may already bank with that may offer these types of things. Read at least one article about the benefits of a Roth IRA, how you should use it, what are some of the limits for contributions and distributions, and just learn a little bit more this week. And finally, look at your budget. Like I said, identify an area where you can redirect 50 to $100 and begin redirecting that and make a plan to invest that money that you're redirecting out of one of your budget categories. That's it's really just one step, but I broke it into three things. But it's a little bit of education from going into your own company's HR portal and finding out what money you may be leaving on the table, doing some research about an IRA account to find out how you could get one and open one yourself, and then finally looking at your budget and finding out 50 to $100 that you can carve out or redirect that's going somewhere else right now and get that flowing towards an investment account. So we go much deeper on all these topics inside the MOB community. We're always extending invitations for you to join our community. We have the community available for you at 3 tiers, so there's no excuse not to join. There's a free tier. We've packed it, ton of value, over 9 lessons, templates, resources are in there. You walk away with 3 absolute bangers for value and deliverables that everyone should have: a spending plan, an operating account to begin good stewardship and management. We have the paid community. The first tier is just $47 a month. You can pay it out for a year and save, I think, 2 months. If you join that way, you have access to a ton more teaching. You have access to weekly coaching calls with myself. And then we have a 247 tier, and that's way more access. You get all the templates, you get the full community, but you get one-on-one sessions with me where we can look specifically at your situation, develop a strategy for you not only to manage your resources, get the foundation in place, but begin to think about how you can multiply and create wealth. So if this week resonated with you, go ahead, run down in the comments, type multiply, and we'll send you a DM and we'll get connected and we'll figure out how we can serve you better. So thank you for spending some time with us. Greatly appreciated. And just to close us all off, now I'm asking you to take another step. Stop being the only worker in your financial life. Start putting your money to work, because the goal was just never to have stability. The goal is to build something beyond yourself, for your family, for generations beyond you, and for the principle of stewardship, in order to support the initiatives, the cause, and the ministries that are meaningful to you. So it moves us from success to significance. That is the purpose of multiplying our funds. So thank you again for spending some time with us. Thanks for joining us at the MOB Academy. Now stop scrolling and go mind your business.